Hey, welcome back, handsome devils. In this video, we're going to discuss why some REIT investors actually lose money. And towards the end of the video, be sure to stick around. I'm going to present one of the easiest and most proven strategies to experience long-term success investing in REITs. More on that coming up. It's a little bit funny, in the intro of the video, I called everyone a handsome devil, and I actually had a female subscriber reach out and say, hey, are there not any females that watch your videos? And I actually had to show her the stats that about 90% of the viewers are males aged 25 to about 40. So it's really kind of funny. So I told her, feel free to invite a bunch more females to the channel, but that's why I do the intro sometimes, handsome devils. In this video, again, we're talking all about REITs, real estate investment trusts. This is more of a little bit advanced video, not really necessarily for someone that's just getting into real estate investment trust investing that may need to do some basic research and maybe understand some basic vocabulary and terminology within the sector. But here's what you should know. And this is sometimes what moderate and even expert investors don't really realize sometimes when they get into REIT investing. So the first thing that I want to bring up where REIT investors tend to expose themselves to more risk than they should is not considering taxable liability. Now, I've actually gotten the belt on my channel a couple times for people saying, Kenny, why don't you talk about taxes? Why don't you talk about taxes? Well, for one, I'm not a CPA. And second of all, I have a global audience. So taxes are really irrelevant for a certain group of viewers on my channel, but predominantly, since a lot of you are in the US, I feel it's prudent to mention taxes in this situation. So according to REIT, which is a great resource, here's their website, almost 60% of distributions and dividends from REITs, income that we receive as investors, is taxed as ordinary income. So that's higher than if you just own Johnson & Johnson and collect the dividend that way. So a big mistake here, what REIT investors do when you're actively living off of that income is you're not setting enough aside for taxes. Again, speak with a CPA. I am not a CPA, but this is something that I wanted to point out. Whereas 17% is return of capital, and generally almost a quarter is long-term capital gains. So yeah, you're getting that extra yield when you invest in REITs typically, but again, they're taxed at a higher rate. That's why some of you may have heard, oh, own these in a Roth so you're not paying taxes. Well, that's true. Doesn't necessarily mean that it's bad to own it in a taxable brokerage account if you're looking to live off of REITs before the age of 59 and a half. So that's mistake number one, not taking taxes into consideration. Mistake number two is not really realizing what you own. This is a little bit more of a moderate to newer beginner mistake, but really there's two types of REITs. There's REITs, just REITs in general. Typically people are talking about equity REITs, REITs that own actual, brick and mortar, land, homes, apartment buildings, commercial space, the actual physical tangible asset, okay? And then there's mortgage REITs, or MREITs for short. They basically just own debt. That's all they do, is they own a pool of mortgages, CDOs, collateralized debt obligations, okay? So they don't own any real estate whatsoever. They simply own debt. Now, there's some that own a little bit of both, and there's little variations in between, but primarily these are the two main types of REIT. And so I have a red star here. These are typically higher risk. Now I say typically, there's always one example out there that someone points out to me saying, no, actually, Kenny, well, I'm saying generally across the board, these are higher risk due to their inherent business operations. How they operate, these MREITs, is they borrow money, so they go into debt to purchase debt, right? They borrow money at a lower interest rate, buy debt at a higher interest rate, and they make money off of that spread. So they use a lot of leverage. They're typically more interest rate sensitive, which we'll get to in a moment, but just keep in mind that higher risk, although sometimes potentially the better opportunity for more reward. So keep in mind those two big differences there and realize what you own before you ever invest into it. And don't lose money by going after highly leveraged MREITs. Not all MREITs are bad. Usually it's a little bit better to own equity REITs, a little bit less volatile, a little bit less leveraged, and you'll see this on the screen, the leverage amounts historically and the averages of that. Now, number three is Fed rate trickery. There's a lot of misinformation out there, or half-truths, so to speak. With the federal funds rate, or for short, the Fed rate, if you're not entirely sure what this is, I don't want to make this video longer than it has to be. This is actually a very simple term. Investopedia has a really simple video and definition on it, but essentially this is the Federal Reserve's way of controlling the supply of money. So depending on the economy and the health and the global business arena, they may loosen or tighten the money supply. So the federal funds rate, it's really interesting how REITs apply to this. Now, in a lowering rate environment, when loose money supply, right, when people are getting drunk on cheap money, you can go get a loan for dirt cheap, although CDs are paying nothing, right? So when the rates are lowered, investors go out to higher risk asset classes because they want that yield, because keeping money in the bank doesn't pay you anything. Bonds typically in these situations don't pay too much unless you buy junk bonds, right? So I want you to understand that when the Fed lowers rates, okay, they're loosening the money supply, they're forcing all the money out into the economy, so people are buying and selling and borrowing and doing, right, and conducting business. So money is very cheap. It's easy to go get debt, right, at a very low interest rate. Okay, so investors have to take on more risk to get any yield, right? This is typically traditionally when people say REITs do well in these type of interest rates because they can buy debt at low service costs, they can buy buildings, right, at low debt service costs. Okay, now in tightening rates, right, in tightening the money supply in a rising rate environment, people traditionally say that REITs do poorly because it becomes more expensive to get a mortgage on the building, right? Service fees are higher. Well, equity REITs specifically, and the misnomer here is when rates increase, sellers in the stock market tend to dump their REITs. They tend to sell the REITs because they figure rising rates are bad for the REIT sector. But the reason why you see these big fluctuations in REIT prices sometimes in a rising rate environment is because the actual sellers themselves getting rid of their REITs, putting downward pressure on that share price, as well as they believe that the higher cost of borrowing is going to impede the business model of some of these REITs. So there's a little bit of truth in this. Mortgage REITs, their entire business model is extremely rate sensitive, right? Because all their money is made basically on the spread of rates. They're borrowing money to buy debt. Whereas equity REITs, if it's a very disciplined, very strong balance sheet equity REIT that owns buildings that are cash flowing, a rising rate environment typically means that there's a strong business cycle, a growing economy, and this low leveraged equity REIT can generally charge higher rents, more cash flow. So just because we're in a rising rate environment, that doesn't necessarily mean it's bad for REITs. And that's typically when people sell out. But I'd like to point out that if you were to hold REITs long term, that's where patient and disciplined investors really get rewarded. And here up on the screen, I have one of the easiest ways to invest in REITs. VNQ is a Vanguard ETF. It's a Vanguard REIT index. And I have it compared here to SPY, which is the S&P 500. Now, some people might be asking, Kenny, why aren't you using the Vanguard version, VOO, of the S&P 500? Well, that only goes back to just about 7 or 8 years ago, so I wanted to go back to include 2008 just to show this performance. So we have VNQ in the red and we have SPY in the black. As you notice, just barely, real estate, even holding it through 2008, you actually came out on top compared to investing in the S&P 500. Now, let's look at the performance. Let's look at the best 1 year and the worst 1 year of both investments. So on the top left, the best 1 year for the real estate for VNQ was 110% in the upside. That's right after the crash, April 09 to March of 2010. 1 year on the worst is, again, the financial crisis, the credit crunch, down almost 60% on the lower left there. And then the S&P 500 down about 44% in that same time span. So what's really interesting is you can see that, REITs went down, but they also went up a lot more. Now, don't let that 110% increase confuse you. You say, oh, it only went down 58.17%, but the very next year it went up 110%. So, wow, not only did I dig myself out of the hole, I actually made money. Well, that's not entirely correct. It's really easy to get confused on the impact of losses. I'd like to show you this up on the screen here. If you take a 60% hit, if you see that in the lower part of the picture here, 60% hit, you need 150% gain just to get back to even, right? Because you need 100%, 150% of where you're at in the hole, right, of that amount, just to get back up to where you were. So never let those types of bounce backs confuse you into thinking that you're recovered. So if we look at the trailing returns, we'll see that over time, REIT investors can make money as long as they hold quality and they stay diversified and they don't take action based on what rates are doing, right? Because typically real estate investment trust investors, they're investing for income, right? They're not investing for buy and sell strategies or, any of these other types of, growth strategies potentially, right? You're buying for income. So it's okay if there's a little bit of volatility because long term you hold REITs for their income. Now I'd like to point out one more thing which I find really interesting is if we look back at this first chart, you'll notice the S&P 500 and VNQ, which is a large basket of REITs, really isn't correlated as closely as people might think. Let's look in August, maybe late summer, Q3, Q4 of 2016, you see that REITs really had a nice jump, whereas the S&P stayed fairly flat. And then we see later in about 2017 when the S&P had a nice spike and real estate actually went down. So it's really interesting that you can own two different assets like that because there is a lot of real estate in the S&P 500. Now I'm not advocating for the S&P or for VNQ or for real estate investment trust in general. I just want to show you the long-term performance based off of a very common index that most of us know, which is again the S&P 500. Now, what's really interesting again with that uncorrelation, it might be cool to have a split ticket where you own 50% of VNQ, 50% of SPY. There's different things like that. You don't have to pick just one. Of course, always do your own research. And remember, with real estate investment trusts, some are heavily dependent on rates. Others, it's just a minor speed bump, right? When you own quality in growing economies and strong business cycles, REITs still tend to do well. Don't follow the sheep off the cliff by selling, right? Don't follow the blind sheep and just do that blind trade and sell because everyone and your mother is selling. Although the higher cost of borrowing is an issue, again, if you own quality, it tends not to be a huge deal. Now, if you're interested in a lot more REIT information, specifically different REITs that pay monthly, quarterly, or building a REIT portfolio, be sure to check out the videos here on the screen right now. Also, I'll drop links in the description below. If you enjoyed this video, let me know by giving me a thumbs up and leaving me a comment in the comment section. Thank you so much for watching, and we'll see you guys next video.
You smell that? What is that?
What?
What's that smell?
The cologne?
No.
Opportunity.
No. Money.
Oh, okay.
I smell money.
Okay.